Cool. Okay, welcome to our webinar today. This webinar is being recorded as we do with every webinar. Any questions you have, just type in the question box like you guys just did now. And the idea is that there will be a section where we discuss questions anyway. The idea is that any questions you might have, what we're discussing, it'll help us a lot. If I can't answer it, I'll come back to you by email. So just to get going, on the 23rd of February, our Minister of Finance, Pravin Gordhan, tabled South Africa's 2016-2017 budget in Parliament. And part of this, he announced a number of tax amendments that will have a significant impact on South African savers and investors. But South Africans, as some of you might know, are notorious for not saving enough. So the question today, how many of you would like an investment that encourages disciplined saving and is also tax efficient? I think a lot of us would like to hear more about that. So the idea today is that we're going to talk about an investment vehicle that helps you contribute regularly to helping you build your investment, number one. And that investment can be used for a significant cash requirement, be it university fees for your children one day or overseas holiday. But the whole idea is that it's after a 5-year period. Yeah, so some of you might allude what I'm talking about. So very simple. And here's a quote from Warren Buffett. There seems to be some perverse human characteristic that likes to make easy things difficult. So investing doesn't have to be difficult. Those are our criteria. Let's find an investment that's going to grow, and obviously it's going to be tax efficient. But saying that, let's look at a bit of a case study or a bit of a story. So what is the current position for many people? So I got an example of a chartered accountant. He's earning over 400,000 Rand per year. He has his normal investments. He's got a share portfolio. He's more of a long-term investor. Obviously, a portfolio mixed between value and growth stocks, and also obviously giving him dividend income and obviously growth in those dividends. He has a wide, being obviously chartered accountant. He's got many retirement annuities, taking full advantage of that. He also has some tax-free savings plans. It's mainly for his children, but he's in a situation now. He's got some spare funds, but he wants to access that investment in a shorter term. Last week we had a presentation on retirement annuities, and you know that you can't access your funds before the age of 55. A bit more longer term. So he wants something a bit more shorter term. He wants to know what his options, and that is what we're going to talk about today. So here's another quote from Warren Buffett, by the way. When we own portions of outstanding businesses with outstanding management, our favorite holding period is forever. So that's the whole idea about what's Warren Buffett's success. He's a long-term investor, and this is what we're talking about here. But it doesn't have to be long-term. We're talking about 5 years plus. Okay. So the idea is that, as I mentioned last week's presentation on retirement annuities, says that the longer the period, 15 years plus, then volatility is eliminated out of the equation. Okay. So what is the ideal situation? We want to be in a situation where, especially with our example of the chartered accountant, be in a situation where you have access to your investments. Okay, there's my access to my little piggy bank. I've got access to my funds, but also I want a situation where I have access to investment that is growing. Okay, more than inflation, for example. But also, as I say, I want to be in a situation where it's tax efficient, and we'll talk about it in more detail just now. And ultimately, I want to be in a situation where I have peace of mind. Okay, I can relax, my investments are in order, and that's the ideal situation to be in. I think a lot of us want to be in that same situation. As I said just now, simple. Those are my criteria. So how do we get there? Okay, how do we get there? The proposal, or what are we proposing today, is what they call the new generation endowments. Now, this is an investment product or investment vehicle that offers attractive tax benefits, especially for those investors that have higher tax brackets, but also that has at least a 5-year tax horizon, that you can invest longer than 5 years. So unfortunately, endowments has, a lot of you might be skeptical and a lot of you might be unsure about investing in these endowments. But historically, we've had a situation where, especially with the older generation endowments, they charged higher fees and obviously offered lackluster returns. But as I say, those are the old traditional or old generation endowments. When I say the fees, it was mainly around early termination. So you got penalized for early termination. That's number one. And number two, the fees themselves were difficult to understand or to determine. So this is what I'm proposing today. And there's 5 main things I want to talk about. It offers attractive tax benefits. Okay, the fees are transparent. These are the new generation endowment. Fees are transparent. There's no surrender or early termination penalties. However, there are limitations, but I'll talk about it just now. But also, you have access to a wide range of underlying investment options. And as opposed to or compared to retirement annuities, there's no restrictions on the maximum levels of equity or offshore exposure. So last week I spoke about Regulation 28 of the Pension Act that doesn't apply to endowments. But let's go into more detail about these benefits. So these are, as I say, the new generation endowments, especially the ones offered now on investment platforms, have evolved over the years, and many have become more, call it, investor friendly. But as I mentioned just now with the budget speech, given the recent capital gains tax increases, now may be the perfect time to consider including endowment in your investment portfolio, and I'll explain to you why. So, going to our scenario with the chartered accountant. This is the current tax tables, and you can see I've highlighted this where that little gentleman fell into. Okay, paying more than 31% tax. So the scenario here, if you're earning less than that, obviously you can still go the unit trust routes and things like that. It's more viable to maybe look at things like retirement annuities first of all, and then obviously the tax-free plan, and obviously unit trust directly. But the idea here is that we're talking about tax efficiency. Now, tax-free does not mean tax efficient. Tax efficiency is determined by the degree to which returns on an investment are reduced as a result of tax, regardless of whom the tax is being paid by. And you will see in my next slide where I talk about that in more detail. So bottom line, the less tax, the more tax efficient. That's what I'm talking about. So the important change to note with obviously the budget speech was the increase in capital gains tax, the inclusion rate. Okay. Now, the idea is that obviously from investment, we as investors, the biggest challenge to us investors with this inclusion rate, the increasing inclusion rates, is that it's going to result in us paying, or you paying, higher taxes when you make a profit from the sale of an asset, be it a share or be it a property, whatever the case might be. So just understand that's a scenario. So this has resulted in renewed interest in this new generation endowments, which offers a tax benefit, obviously for the higher tax rates. So in the past, let me look at the 2 scenarios. You as a natural person, that's our tax rate we're talking about, between 18 and 41%. If you're investing just in unit trust or in shares, for example, okay, and you make a taxable a capital gain, your first 40,000 is excluded of profit. It's excluded out of the equation. But then they've increased the capital gains inclusion. The effective tax rate now is 16.4. But remember, it was 33% for individuals. It's been increased now to 40%. Okay. By the way, for companies, it has increased from 66% to 80%, and for trusts also from 66 to 80%. Now, 40% of your maximum tax rate is maximum tax rate 41%. That's the maximum you'll be paying, 16.4%. Okay, on your gains. Obviously, if you earn less than 31%, it doesn't work. It doesn't really help you to be involved in endowments. Okay, so but within the endowment, okay, a person who's got a marginal tax rate of 3%. Okay, your effective tax rate is only 12%. So you're saving yourself 4.4% in capital gains, in taxes there. So that's where it's so powerful. Okay. So who is this endowment product suitable for? It's for, as I mentioned now, investors who pay income tax more than 30% per year, but also for investors looking for a product that requires a disciplined approach to saving. So, you have a debit order in place, you pay yourself first, and your investments are in place. That's what I call an easy, disciplined approach to the market. But also someone who wants to structure the estate in a more tax-efficient manner. So endowments, what's nice about endowments, you can nominate a beneficiary. Okay, that's a very important thing to look at when it comes to from estate planning. So talking about estate planning, so there's no estate duty because you nominate a beneficiary. Your beneficiaries, your children, your wife, who's ever left behind, can decide if they want to have it paid out, okay, or keep the endowment invested. Now remember, when it gets paid out, it's net of tax. Tax has been taken off already. Okay, so they'll have a net situation. If you do not choose any beneficiaries, just understand that your investment will be paid into your estate, and obviously executive fees and estate duty might be charged on your money. My philosophy is, geez, worst case scenario, I nominate a charity, my favorite charity or a church or something. Okay, instead of me giving it to the state. Okay, that's how I look at it. What are we proposing? As I said just now, you got access to more than 484 different unit trusts to choose from. You've got a wide range of investment options. And by the way, if you click on this link here, it will take you through to the funds A to Z. Sorry, the funds list. It gives you a breakdown of all the different funds available. That's number one. And number two, at the bottom here, if you click on this, there's a tool to help you scan the market, look for different, or scan the different unit trusts to find shares, find unit trusts that'll fit your risk profile and your needs. Just also understand that on our platform, you can also switch between these underlying options. I can switch from one fund to another fund. Just be aware that it could trigger capital gains. Okay, but there is also a cost involved if you do withdraw the funds. But I'll go into that into more detail just now. So, what will endowments do for you? What are some of the benefits? So I said just now to help you save with discipline. If you've got a 5-year horizon, okay, if you've got discipline not to withdraw that, it's great. We're talking about limitations on that just now. We've spoken already about the tax benefits, and we've also spoken about the estate planning, and obviously the wide range of funds available. So those are the benefits available to you. So I know that some of you might have a lot of questions, and you're thinking, well, what are the what about this? What about that? How much can I contribute? What is the monthly contributions? You can contribute a once-off, a lump sum of at least 20,000. That's number one. Alternatively, you can have debit order investments, minimum 500 Rand a month, or 1.5 quarterly, 3,000 half yearly, or 6,000 yearly. Okay. Alternatively, you can also make a once-off, a lump sum, and you can make a bit of an ad hoc payment, add debit order investments to it. You can also add and stop your debit orders as and when you want to. So that's quite flexible. That's what I like about this product also. It's very, very flexible. And this is where there's some of the limitations come in now. How do I gain access to my investment? There's an initial restriction period of 5 years. During this initial restriction period, you can withdraw. You can have access to your funds. You can make one loan from the investment without being charged interest, or you can also make one withdrawal without having to pay it back. Okay, but also you can access the investment after this period, and there's obviously no limitations on that. If you want to withdraw within the period, there's one criteria: the value of your loan or withdrawal cannot be more than the money you've invested plus 5% compound growth per year. So as I say, there are limitations, but you do have access to it. Those are the two options. But also they have this what they call the 120% rule. And this is also very important to understand from a contribution point of view. There are no restrictions on the contributions in the first year, but from year 2 of your investment onwards, if your annual contribution exceeds 120% of the larger of the 2 previous years, Okay, so those 2 previous years, so for example, in the first year we contributed 200,000. The idea is you want to contribute as much as you can. Okay, in your first year. In your second year, let's say our contributions was 100,000 rand. The larger of the two amount, which is the 200,000, your third year, it cannot be more than 120% of that. So 120% of 200,000 is 240. You cannot exceed the maximum you can invest in your third year is 240,000. Okay, if it is more than 240,000, you start a new 5-year period. Okay, so I hope that makes sense to a lot of you guys. Okay, just understand it's a maximum or larger of the 2 previous years at 120% of that amount. Okay, as I said, this presentation will be sent out to you guys. Just review this presentation. If you have any questions, you're welcome to drop us an email or phone our client service department. Okay, so who is this not suitable for? Okay, the endowment is not suitable for investor who wants to invest for a shorter term period. Okay, less than 5 years. Okay, so I hope that makes also sense for you guys. What happens if I miss or stop or reduce the debit order? So first of all, you can limit or you can lower your debit order to a minimum allowed, which is, as I say, 500 rand a month. Alternative, you can also stop your debit order completely if you need to. And you can also stop your debit order and restart later. So it's flexible. Just understand one thing. If you do restart, a new 5-year restriction period will start also. So those are some of the limitations or some of the criteria around the contributions and the debit orders. Also very important for a lot of people, can I use endowments as a security for a loan? And the answer is yes. You can use your PSG Wealth Endowment as security. In other words, you can loan it to the bank or to any other credit institution as collateral. That's number one. And you can also cede your endowment outright to a third party. The third party will then become the owner of the investment. So, if you owe money to someone, this is one way to pay him back. Cede your investment over to them. What are the fees? What fees will be deducted and what are they for? So first of all, obviously, we've got an ongoing investment admin fee. For PSG funds, there's no initial fee. Okay, and the ongoing fee is 0.2%, with VAT 0.28%. That's for PSG funds itself. Other funds, for your first 1.5 million, 0.5% plus VAT, 0.57, and then works on a sliding scale. Anything above 1.5 million, then it slows down to 0.2%. That's number one. So obviously you got that admin fee. You also pay the asset management fees, but it's priced into the unit price already. If you do have a financial advisor, for example, advice fees will be deducted, but this you discuss directly with your advisor. And I mentioned just now, if you do decide to withdraw from your endowment before the 5-year term, there is a fee of 1% on the withdrawal amount. Okay. Then the fund management themselves will charge depending on the underlying investments that you choose. So those are some of the fees involved. So let's look at what questions you guys have. Bring out my questions. These are questions. Just type in the question box. How much to get? On the question here, how much to get 0.2 on other funds? As I mentioned, Jan, over 1.5 million investment, and it works on the sliding scale. Okay, I hope that answers your question. Are there any other questions? Cool. Here's one question from Asandra. Okay, can you use the endowment fund as surety when buying a house, for example? Wow, not 100% sure. So I have to come back to you on that one. That's the first time I've had that question. If anybody else can maybe answer it, one of my colleagues on the phone. Okay, here's a good question from Stuart Murray Smith. Can I buy an annuity that someone wants to give up? So it's not much an annuity, Stuart. There is what they call second-hand endowments. So after that initial 5-year period, you can plow as much money as you can into it. That's the whole idea of the second-hand policies. But obviously, if it changes ownership there is capital gains taxing implications. So you can buy these second-hand policies from someone else. Just understand that there's capital gains involved. It's not so much annuity. Okay. What other questions we have, guys? There's your opportunity. Okay, Stuart, pleasure. Okay, a question from Trevor. Can I transfer, say, 1 million from my provident fund and not pay any lump sum tax? Transfer from the provident fund, I think then it has to go into a preservation fund. Trevor, I'm not 100% sure transferring into endowment. No, that's after tax money. Okay, so I'll have to come back to you on that, Trevor, also. I'm not 100% sure, but the way I understand it, it goes from your pension or provident fund into a preservation fund. It's the only route you've got. Okay, if I only invest, sorry, Jan, coming back to your question, if I only invest 1.5 million, do I get one? It's over. Yeah, it's over. You need to invest over 1.5 million. What is the rate then on the sliding scale? Okay, Jan, I'm not 100% sure, because remember, if it's other funds up to 1.5 million, it's 0.5. Over that, and it slides down. So, for example, you invest 1.5 million, 1.6 million, 1.5 will be at 0.5, and other 100,000 will be at 0.28. So I hope that makes sense to you. Sandra, can I have 2 endowments policies, but a separate? Yes, definitely. And people have various different periods for different needs. So you definitely can have more than one endowment for different periods. Okay. I hope that answers your question. Sandra, let's come back to you on the surety side. Okay. Stephen, okay, pleasure. Yes, leave a bit early. Cool. Looks like that's all the questions coming through. Okay. Guys, thanks a lot for participating and thanks for those questions. Let's quickly just wrap it up. Things what I want you to remember from this presentation: the PhD endowment offers you, as I say, attractive tax benefits. There's no state duty. Very, very important. Fees are very transparent. You have access to a wide range of underlying investment options. And also, I find very important, you're not restricted to the maximum levels. Remember that Reg 28, you have to comply those rules. Yeah, you don't have to comply those equity and offshore instruments. You have a wide range to choose from. Okay. And then your next action steps, those of you that don't have an endowment policy and that feel that they need this, open up an endowment account today. But if you want more information, go and click on this link. It takes you to those more information on endowments. If you want more information, also click to our client services. There's the email address and there's the contact phone numbers. Okay. So I hope you've enjoyed this webinar today, a bit more informative on endowments. Our upcoming webinars, obviously next week, Wednesday, we'll be coming back to more technical analysis and trading. Very basic approach to technical analysis, doesn't have to be complicated. So the way I approach technical analysis, I've been doing it for 125 years. So we discuss some of that. The week after that, we talk about retirement myths. And then obviously today's presentation, I spoke more about individuals and endowments. On the 18th of May, I'll be talking about how your family trust can benefit from investing in endowments. Big benefits also from a family trust point of view. 25th of May, we talk about fundamental analysis, more value investing, and we're going to highlight 5 opportunities we see in the market at that time. And then we talk about income and your retirement savings in the beginning of June. Then we talk about currency futures, the 8th of June, how to hedge and speculate on the rand. Those of you that are into trading the index futures, those of you more swing traders, we'll be discussing swing trading and index futures trading on the 15th of June. And on the 22nd of June, we're discussing how to use single stock futures, how to hedge your share portfolio using single stock futures. Okay. Hopefully I'll have information on our website very soon regarding our upcoming seminars. It'll be at the end of May. Bloemfontein, Durban, and Johannesburg. So that's what we're going to do this quarter. But I'm still just confirming the venues, new venues. and obviously to be more investing and trading along those lines. But guys, thanks for participating on this webinar again. Until next week, and enjoy your public holiday tomorrow. There's my contact details. If you want to answer questions or ask me to ask questions, drop me an email. I'll gladly do that for you guys. But from my side, thank you very much, and all the best. Until next week, keep well. Bye for now.